It will be a busy week of central bank meetings. Jay Powell will hold his last policy meeting as Fed chairman, and Kevin Warsh may finally be nominated as the next Fed chairman after the US Justice Department dropped investigation into Powell. More central bank announcements will come out throughout the week. The Bank of England and the Bank of Japan will be among central banks to decide on interest rates and review inflation risks, as investors keep expecting higher interest rates in the year ahead. Meanwhile, the US earnings season will heat up with big US tech companies, including Amazon, Microsoft, and Meta platforms reporting their financial statements during the week. That could fuel more volatility in the record rally of the US indices. So let's have a look at what the chart suggests and what the events could mean for dollar yen, pound dollar, and the US100 index. So let's first have a look at dollar yen and the Fed's rate decision. Expectations are for interest rates to remain steady, and given that there will be no forecast for interest rates or economic indicators, the focus may shift to Powell's press conference. His inflation comments might be important in providing new clues about inflation risks and whether probably a tightening monetary policy is more necessary or not. So press conference commentary could create some volatility for the US dollar, and from a technical perspective we can see that the pair keeps struggling to close to maintain a positive momentum above the 159 level. It failed to break above 160, and it has been below this level for a couple of sessions now, currently testing the 20-day moving average near the 159 round level and around the 20-day moving average. So overall, we can see that the uptrend that started from February seems to be facing weakness. It's losing momentum, and perhaps a break below 159 could still be possible given the negative slope in the technical indicators down here. And don't forget that the Bank of Japan also decides interest rates before the Fed on Tuesday. It will be interesting to see whether policymakers will call for a summer rate hike, as expectations remain high for at least one rate hike in the year ahead. So a hawkish commentary from Bank of Japan could actually trigger an earlier downfall, and perhaps we could see a tough battle between 159 and 158. That will be a critical critical support for this uplift. If the price fails to hold here, then that could trigger a sharper decline towards 157.22. This overlaps with a 38.2% Fibonacci retracement level of this uplift. And lower than that, the 50% Fibonacci of 156.25 could be the next target. Note that any break below 158.50 could actually put this uplift into question. Now, in the event the Bank of Japan fails to support the yen, and if Japanese officials don't intervene to support the yen either, then any hawkish commentary from the Fed could actually easily help dollar yen to rise above 160, and in this case we could see another test near the 160.40 resistance from the end of March. Successful penetration higher could then trigger a nice rally in towards the 162.55, where this resistance trend line over here, which connects the highs from 2025 and January 2026, is placed. Now looking at pound dollar, well, the Bank of England is also expected to hold interest rates steady. The voting structure, well, expectations for the voting structure are for all policymakers besides one member to decide on steady interest rates. But hawkish divergence might not be a big surprise given the rising inflation data in the UK. So some hawkish commentary could still be possible, but a clear shift to a tighter monetary policy looks currently unlikely, given that the unemployment rate is still at around a 5-year high. So perhaps some hawkish commentary could help pound dollar to extend its recovery from Friday. We can see that the price has returned above 1.35 and the 1.36 is currently could be the next resistance. Successful penetration higher could take us as high as 1.37, and then beyond that all the attention will turn to the 1.3810 and 1.3825 territory, which includes a long-term resistance constraining line. Now, if we look at the technical indicators down here, well, those are supporting, those are actually backing the current recovery phase in the price. The RSI is above 50, the stochastic oscillator is pushing higher, so that's an encouraging sign that perhaps we may see more gains in this market, especially if there is a hawkish divergence within the Bank of England's board. Nevertheless, if the price pulls lower, if geopolitical risks return, then with the price falling below 1.3490, then the 1.3445, which was last week's sub-pivot area, may come under examination ahead of the simple moving averages, which are all currently concentrated within the 1.3380 and 1.34 zone. So that could be a critical support region. If it fails to hold, then this up leg may come into question, likely with the price likely falling, staging a steeper decline towards the 1.33 number. That seems to be that is the neckline of this short-term double bottom pattern over here. So another decline below this threshold could renew negative risks, shifting the attention towards the 1.32 number. And finally, having a look at the US100 index, as the earnings season could heat up later this week with important US big companies reporting their financial statements. The AI optimism has been a key driver for this record rally, particularly, and probably it has actually balanced all the geopolitical risks driving the US100 index to a new all-time high of 27,405 earlier today. The key question now is whether this record rally will continue if big tech companies report better than expected earnings, and if they sound more optimistic about AI growth and future returns from AI investments, then perhaps that could extend this rally. Nevertheless, from a technical perspective, the price has been on a continuous rally most of the time since the end of March. So this rally, as it looks overstretched, and the technical indicators down here are supporting this case. We can see the RSI, the stochastic oscillator, losing some momentum, flatlining above their overbought levels. So I would rule out some profit taking just above the 27,000 psychological mark. If this happened with the price dropping below the 27,033, then perhaps we may see a steeper decline towards the 26,000 and 26,255, while lower than that, the 20-day moving average could come next into view for the first time since the start of the month, near 25,550. Now, if the rally continues, well, the next target is the 28,000 round level, and that could come ahead of the critical resistance trendline area between 28,375 and 28,675. So it will be quite interesting to see whether this rally could actually stage such an impressive rally. And we can see that losses from the war in Iran are already in the past, so that's a new phase for Wall Street. So that's everything I wanted to share with you guys. I hope you like my analysis. So please subscribe for more technical updates. We'll be back on Thursday for more analysis. Thank you for watching, and see you next time.